Welcome to today's Explainer. We're going to map out the exact plumbing of the stock market today. We're taking a bit of a journey, starting way up high at the macro level of those massive stock exchanges, and then we're going to work our way all the way down to the micro level, the specific everyday investment vehicles that you can actually buy. Let's get right into it. So there's this great quote. A stock exchange is a formal link between businesses needing cash and people wanting to generate wealth. I want you to think about the exchange like a massive, highly regulated supermarket. On one side of the aisle, you've got cash-hungry businesses looking to fund their next big expansion. And on the exact opposite side, you have people and institutions looking to generate wealth. The exchange is just the meeting place where they finally do business. Here is our roadmap for today. First, the stock exchange explained. Second, 5 functions of exchanges. Third, mutual funds versus ETFs. And fourth, choosing your investment strategy. Section 1, the stock exchange explained. Now, to really understand the modern market, it helps to look at some of its historical anchors. Think about the Bombay Stock Exchange, which was founded way back in 1875, or the National Stock Exchange, which actually pioneered electronic trading in 1992. But here's the thing you have to remember. This financial supermarket is not a casino. It is a highly surveyed environment. Regulators, like SEBI, enforce incredibly strict rules to make sure listed companies are totally legitimate. And most importantly, they ensure that everyone gets the exact same price at the exact same millisecond. There are literally no hidden advantages here. It's all about fair, standardized trading to keep everything above board. Section 2, 5 functions of exchanges. So we know what the exchange is, but what is that engine actually doing for the broader economy? Well, there are 5 crucial gears turning here. First is capital mobilization, basically funneling cash directly to productive businesses. Second is liquidity, which is huge. It gives you an easy exit door without being locked in for years. Third is transparency and protection. Fourth, it acts as an economic barometer. Think of indices like the Nifty 50 literally taking the pulse of the nation's financial health. And finally, innovation. Exchanges are always fostering new financial instruments, which actually leads us right into our next topic. Okay, so we've talked about the massive marketplace itself, but when you walk through the automatic doors of this financial supermarket, what exactly do you put in your cart? Because usually you aren't just buying a single apple or a single orange. Section 3, mutual funds versus ETFs. These are the 2 primary pre-packaged variety baskets available to investors who want to diversify safely without having to go in and pick out individual stocks all by themselves. Let's start with the classic. A mutual fund is a professionally managed investment vehicle that pulls money from a bunch of different investors to buy a diversified portfolio. But the absolutely crucial point here is how it's priced. Mutual funds are priced just once a day, right at the market's close, based on their net asset value, or NAV. So you can summon an order at noon, but it isn't actually going to execute until the closing bell rings. $28 trillion. That's trillion with a T. That is the staggering amount of net assets held in mutual funds in the U.S. as of 2024. I mean, because they've been around since 1924, they hold this incredible historical dominance and offer a massive variety of active management strategies. But now, enter the modern era, the ETF, or exchange-traded fund. This is also a diversified basket of securities, but here is the real game changer. It trades continuously on an exchange at market prices exactly like a single stock all day long. The very first ETF was only created in 1993, which is almost 70 years after the mutual fund. Yet, despite being the new kid on the block, ETFs have rapidly secured over $10 trillion in assets. They heavily appeal to modern investors who just demand that flexibility and real-time control. So let's put them head-to-head for a second. Mutual funds offer simplified, once-a-day pricing. You don't have to stress about intraday market swings. ETFs, on the other hand, offer continuous daytime trading for immediate execution. That means you can use advanced techniques like limit orders or short selling, exactly the same way you would with a regular stock. Now, the real hidden battleground between these two? Taxes. With a mutual fund, if the manager sells underlying investments to pay out cashing investors, it can actually trigger capital gains taxes for everyone left in the fund. Yeah, even you. But ETFs operate differently. Through what's called an in-kind redemption process, they generally shield you from those unexpected capital gains, which makes them highly tax efficient. Section 4. Choosing your investment strategy. So how does all this macro market structure and micro product comparison actually impact your wallet? Let's break down the bottom line here. Mutual funds often require a minimum cash amount just to get your foot in the door, and they usually carry higher management fees. ETFs, no minimums, you can just buy a single share, plus they generally feature way fewer fee layers. When you factor in the continuous trading and that tax efficiency we just talked about, the takeaway becomes pretty clear. While mutual funds give you that hands-on active management, ETFs generally win out on lower fees, better tax efficiency, and absolute ease of entry. So what should your action plan actually look like today? Well, step 1, assess your risk tolerance. Be honest with yourself. Step 2, decide if you want an active manager out there trying to beat the market, or if you'd rather go with a passive strategy that simply mirrors an index, like the S&P 500, to keep those fees low. And step 3, choose the actual vehicle, mutual fund or ETF, that fits your personal style, your timeline, and your goals. You now understand the supermarket, and you know exactly what those variety baskets look like on the shelves. So the question for you is, active control or passive efficiency? Which vehicle is going to drive your portfolio? Take everything you've learned today, look closely at your goals, and start navigating the market with confidence. Thanks for joining us for this explainer. We'll see you next time.